If you're just starting to think about investing, the first instinct most people have is to open a brokerage account and start buying investments right away. But experienced investors usually build their financial structure differently. Before investing heavily, they make sure 3 key accounts are in place first. These accounts create stability, flexibility, and a long-term investing foundation. Without them, investing can feel stressful and disorganized. With them, building wealth becomes much more structured and predictable. So today, we're going to walk through the 3 accounts every beginner should consider opening before they start investing seriously. Before we begin, a quick note. This video is for educational purposes only. I'm sharing general financial concepts and frameworks, not personal financial advice. The first account every beginner should have is a high-yield savings account. This is not where you build wealth. This is where you build stability. A high-yield savings account is designed to safely store money while still earning interest. Unlike traditional savings accounts that might pay almost nothing, many high-yield savings accounts currently offer significantly higher interest rates. Common institutions offering these accounts include banks like Ally, Marcus, and online divisions of larger banks. The goal of this account is simple. It becomes the home for your emergency fund. An emergency fund protects you from unexpected financial events such as medical expenses, job interruptions, or car repairs. Most financial frameworks recommend building 3 to 6 months of essential expenses in this account. That doesn't happen overnight. It happens gradually. But having this account established early gives you a stable financial base before you begin investing. Because if you invest without stability, any unexpected expense may force you to sell investments at the wrong time. The second account is a brokerage account. This is where long-term investing typically happens. Brokerage accounts allow you to purchase investments like stocks, exchange-traded funds, and index funds. Several well-known institutions offer beginner-friendly brokerage platforms, including Fidelity, Vanguard, and Charles Schwab. These platforms allow you to invest consistently over time. Many beginners focus on broad market index funds because they provide exposure to large segments of the economy without needing to pick individual stocks. The brokerage account is where your long-term growth layer begins. But this account works best when it sits on top of a stable financial foundation. That's why the first account we discussed is so important. The third account beginners should consider opening is a retirement account. For many people in the United States, this means a Roth IRA. A Roth IRA allows you to invest money that has already been taxed, and in return, the investment growth can potentially be withdrawn tax-free in retirement. For long-term investors, this can be a powerful advantage. Brokerage firms like Vanguard, Fidelity, and Charles Schwab all offer Roth IRA accounts that can be opened online. The contribution limits and eligibility requirements change over time, so it's always worth checking the current guidelines. But structurally, this account allows you to invest for the long term while receiving tax advantages. When beginners combine a brokerage account with a retirement account, they create both flexibility and long-term growth potential. Once these accounts are established, they create a simple financial structure. The high-yield savings account provides stability. The brokerage account provides flexibility for long-term investing. And the retirement account provides tax-advantaged growth. Together, they form a very simple financial system. Income flows into stability first, then into investing, then into long-term wealth. Without that structure, investing often becomes emotional and inconsistent. With that structure, it becomes systematic. Let's say someone earns additional income from online work or AI-related projects. Instead of immediately investing everything, they could allocate their money in stages. Some money builds the emergency fund. Once that stability layer is established, additional funds can begin flowing into investments through a brokerage account. And if retirement accounts are available, those can be used to capture tax advantages over the long term. This type of structure helps prevent the common beginner mistake of investing money that might be needed soon. The key takeaway here is that investing is not just about picking assets. It's about building a financial structure that supports long-term decisions. When the right accounts are in place, investing becomes calmer and more disciplined. And over time, that discipline matters far more than trying to predict the next market move. In the previous video, we discussed where beginners should keep their money before investing. In this video, we looked at the 3 accounts that create the basic infrastructure for investing. In the next video, we'll take this a step further and walk through a simple monthly wealth system that shows how income, savings, and investing can work together in a repeatable way. If you're interested in building long-term wealth through structured financial systems, subscribe to follow the framework here on Van Fox. Because building wealth isn't about moving fast. It's about building systems that work consistently over